Okay, very good. Thank you, everybody. Here's a monthly seminar on the magic of life insurance. And we are here to educate and inform and inspire people about this magical product. And we have Darren and we have Charlene with us. Darren is our front line of genius and service. Life insurance underwriter, financial planner. We've been together, 15 years?
Yeah.
Charlene is the glue that holds the organization together. She has animals crawling to the right and left of her. She's a combination of animal whisperer and an insurance brokerage whisperer. So here we are. What we're going to talk about today is life insurance, partially from an estate planning point of view, and it applies to people of a very small net worth, as well as to people of a very large net worth. And the reason is because a life insurance policy is a key instrument in an estate plan. For people of a smaller net worth, it can be a big part of their net worth. For people of a large net worth, it could be a substantial piece of their net worth. And in either case, it has a lot of power, meaning it has the ability to distribute very important assets in the right way. And the reason why these assets are very important is because they are directed towards the care and maintenance and security of very important people, family, business, other, community, charity, and so on. And interestingly enough, the control over the distribution of these assets, in particular the death benefit and also the living benefits of life insurance, they're easily controlled through paperwork transactions. But that's good and bad, meaning if the designations are proper from a legal and financial and mostly from a planning point of view, then things can run very, very smoothly. However, if the designations are not proper, legally, financially, or from a planning point of view, then huge complications can arise. And those very vitally needed assets needed by your family or your business or your community, and the worst case scenario will never get there. And the best case scenario will get there after long delays and kind of defeat the purpose of the life insurance, which is to get the needed money there quickly. If done right, life insurance check comes really fast. If done wrong, you have to wait. And that wait can create severe financial and emotional hardship. So we want to avoid that. So we're going to speak today not as estate planning attorneys. There are additional questions to raise to those experts, but we're going to speak as people who are instrumental in the estate planning of our clients, and learning as they learn from the school of hard knocks what to do and what not to do. So we have a very seasoned perspective on this, which we offer. Again, and when more complicated questions arise, that's why people have attorneys. Okay. So the format will be that I'll kind of start us off, and I'll then hand over the microphone to Darren, and we'll go back and forth a bit. And I think we'll have an educational and enjoyable time, and I'll have everybody out of here in 20 minutes or so. Okay.
Good.
So Darren, we have three areas. We have three parties that need to be designated on a life insurance contract. There's sometimes a fourth, but the three major ones are, of course, the insured, the owner, and the beneficiary. As a side point, I know we have premium payer. Okay. But the three biggies are the insured, the owner, and the beneficiary. Obviously, the insured is a pretty straightforward decision. Whose life are we insuring? Upon whose death do the proceeds have to be paid? Okay. But then I know from our experience, it's when we start thinking about who should own the policy and who should benefit from the policy that things can get a little bit more complicated. So, having said all this, what comes to your mind, Darren, when clients start asking you, well, who should own the policy? Like, what kind of thinking do you convey to help them make that decision?
Yeah, I always, synonymously use the word ownership with control, because the owner literally and legally controls the policy. And I believe most clients understand that, but not a funny story, but if you're the insured and you've designated another individual or company as the owner of the policy, it's the owner that really dictates what happens with that policy. And what do I mean by that? So for instance, this sounds counterintuitive. You can be the insured on your own policy, and you could call the company and they may not tell you anything about the policy, because it's the owner that has the legal rights and obligation to make directives on the policy as far as changes, beneficiaries. The owner is always going to receive every correspondence from the insurance company. Again, it's out of what a layman might think is common sense. You could be insured, you could be the insured. The insurance is on your life, and you don't know anything about it. You're not getting updates. You're not getting annual statements. You're not getting notifications. It's the owner. Well, why in the heck would someone else own a policy on your life? For individual insurance, oftentimes you'll see a spouse own a policy on the other spouse. Why do they do that? Just to be with certainty. And again, it depends on the financial dynamics of the household. Does the wife run the checkbook? Does the husband run the checkbook? Who's doing what? But the wife wants to be sure that her policy it gets paid. The husband anyway. So the point is, that is a consideration. We see that oftentimes. Maybe each spouse owns the other spouse's policies. Business purposes, we see this frequently. Typically, if a business is insuring a key individual, meaning gosh forbid, if something happens to my employee, my business is in a world of hurt as far as driving sales. He's an engineer, technical expertise, what have you. It's the company that will actually own the policy, because they're the ones that need to be sure that that coverage is there. Anything else on ownership we should touch on?
No, I get that. So what you're talking about, like in a marriage or a domestic partnership. You have John and Mary, and they would both be insured, and John would own the policy on Mary, and Mary would own the policy on John.
Yeah.
And one reason to do that is equity, in the sense that, and that also assumes that that they're the beneficiary on each other's policies.
Mm-hmm.
Okay, so if John dies, Mary's going to get a bunch of money. If Mary dies, John's going to get a bunch of money. So it's kind of like right and proper that if there's money coming to John, then he has control over that money even when Mary's alive. So by making him the owner of the policy on her, he makes sure he has the security he needs to make sure he gets that money when the time comes. in some, and in some cases, the couple says, well, I love this guy. We should be together forever. But if it's not going to happen, I don't want him walking off with his insurance money. Okay. I think that's one reason. But I've also come across couples where, parting ways is not even a consideration, but they're like, no, it makes common sense. If this asset is going to be designated to John, John could control the asset. And the only time when you wouldn't want to give the beneficiary that control is when they're a minor, which is, another case. But we're talking about an adult that has an interest, an insurable interest in the insured. Let them control the asset while they're alive, while the insured's alive.
Steve, to interrupt real quick, the
Yeah.
third common scenario that I wanted to touch on, and this this could be a whole topic in and of itself, is trust. A trust can own a life insurance policy, and oftentimes it's structured that way. Legally, we understand that a trust is a legal entity. It has the capacity to own property, own assets like life insurance. Why did people do that? Typically, it's more on the estate planning front to keep that policy out of the estate, keep the death benefit out of the estate. If it's a cash value type policy, to keep that value out of the estate. So again, that's a very broad topic that we may spend another seminar on, but that is something we see frequently as well.
No, I agree. We will have to have a separate seminar on that, and right, a third legal entity owning the policy, separate and distinct from the married couple in this case, would make sense if they don't want to have $10 million in their collective estate, right? Very good. And we'll have to talk about the fact that they relinquish a certain amount of control when a trust does that, when they have a trust. Okay, we'll get into that. Okay. So with a married couple or a domestic partnership, one common practice is to have the partners own the policies on one another and benefit from likewise. Okay. So now to address your point about a business owning the policy, you mentioned that if there's a key person, and the key person could be partners, owners, or it could be an executive or salesperson or somebody that plays a key role. In that case, the business would own the policy on that person. And you mentioned that the business would also be the beneficiary.
Correct.
Okay. Would there be any reason why let's say, partners in the business would themselves want to own the policy as opposed to having the business own the policy? Can you think of any reason why somebody would do that?
It could be. I mean, it could be. It really depends how the company's structured. Is it an S corp, a C corp, a limited liability? So there may be certain tax planning advantages to have it one way or the other. See, I really would just depend how the business is set up, and oftentimes, Steve, this, someone will approach us saying, they're looking for key person insurance, and in effect, once you peel back the layers of the onion, it's really to facilitate a buy-sell agreement. Meaning, God forbid, if something happens to one of the key partners, let's just make it easy. Say there's two partners. If one partner, prematurely dies, then the purpose of that life insurance is to, in essence, purchase that person's, interest in the corporation from, his estate, his family, what have you. So in those scenarios, it's always going to be the opposite, business partner owning, the other person's policy.
I get that. I'll share an interesting tangent on that point. A number of years ago, I sold life insurance to an accounting firm. There were three partners, and it was kind of like key man and coverage in the sense that The partner said, this is an accounting firm, and they said, well, if one of us gets hit by a bus, then we want to have a boatload of money available to keep the business afloat, and to buy the time we need to hire the right partner. Because it's going to take some time. We're very selective.
Yeah.
Okay. So an interesting twist on that was that one of the partners retired, and one of the remaining partners with the firm called me up and he said, you know, so and so retired, but the business owns the policies and we own a policy on him. Can we still keep it? I'm like, yeah. I said, he doesn't not have to be in active employment with your firm. You own the policy and he can't make any changes. And sure enough, a year later, the guy died,
Mm.
like fast acting cancer. And so this company legitimately collected a lot of money upon the demise of somebody who was no longer a key person. But because of the power of the ownership, they retained ownership. And obviously, they kept paying the premium. And they didn't make any changes in terms of they kept themselves, the business, as the beneficiary. Claim was paid, and sweet check was delivered.
That's
Okay.
interesting. I had that exact same phone call yesterday from another identical situation. They were positioning to buy out one of three partners. The company owned a policy, and that was the exact same question. Well, can we give him the policy? I'm like, sure, you can do with it whatever you want. I'm like, that would be kind of a nice, generous thing to do, or you keep it. And I guess this individual wasn't, the perfect picture of health. And they're like, I don't know. I'm like, well, you have the right to keep the policy and pay for it. So, that's kind of what they're thinking right now.
Yeah, and people kind of start thinking about, is this a moral question, and as I've looked at it, no, it's not a moral question. I mean, it doesn't represent any kind of immoral dilemma
Yeah.
because this is a business situation, they've invested heavily in the services of this person, and having the life insurance, retaining the life insurance on that person, even after their active employment, is just icing on the cake, is yet a further return on their investment.
But for the purpose of this seminar, I'm glad we brought it up. It just illustrates the power that the policy owner has. It's
Right.
ultimate power. So whether it's a business or say it's I know nobody gets divorced. Nobody ever gets divorced. But we see that a lot where, there was a divorce and the wife has kept the policy on the ex-spouse, and
That's right.
usually obviously it's justified because there's children or what have you, but having the power of and privilege of the ownership is everything. And yes, we can change ownership. You're allowed to change ownership. For anybody watching, they're like, well, wait a minute, I have life insurance. I don't think I structured it properly, or maybe, my agent didn't advise me properly. We can certainly audit and, make recommendations as far as ownership, beneficiaries, what have you.
Yeah. Yes. Okay. And yeah, and if there is a divorce, unfortunately, I mean, I've seen situations where John and Mary do get divorced, and Mary retains the policy on John because she's the owner, and then Mary marries a guy that's worth 10 digits and has a big boat and six houses, and John kind of goes to Mary and say, do you really still need this policy? And so they talk, and they negotiate
Sure.
it, and they do what they're going to do, and they have a financial coach, and they talk to the financial coach and the planner, and they get involved, and they talk. But assuming that the couple does have at least a halfway decent communication still, then post divorce they still would negotiate something if their circumstances change. All right, in the last few minutes I want to focus a little bit on beneficiary,
Mhm.
in particular, the scenario in which people want to make their children the secondary beneficiaries. In other words, John and Mary are the owners and the beneficiaries of each other's policies, and they have three kids that are now minors. Um, what would happen if, God forbid, John and Mary did die in a car crash and their kids are still minors, and their kids, though, are named as contingent beneficiaries, and they're like, the kids are like 8, 10, and 12? Would the company just send out a couple of $1 million to these kids, or what would happen?
Yeah, that was a key point I wanted to hit on is, as we know, legally, a minor doesn't have the capacity to contract. Now, the definition of a minor might be slightly different in each state, but the short answer is no, you never want to designate a minor. It sounds like a good idea as a primary beneficiary, because, point blank, an insurance company can't send a check to a minor.
Okay.
So in essence, it gets paid to the estate. Well, what happens when monies go to the estate? You've heard of probate, and usually there's bad words that come before probate because it's never a pleasant experience.
Yeah.
I work closely with a local estate planning attorney, so I usually see all the bad things that happen because people didn't do things the right way, because that's why he's involved. So again, if you have existing coverage, or if you're working with us and we're recommending, new coverage, that's something that we're definitely gonna keep an eye on. Now, to your initial question, if you list a contingent or a secondary beneficiary, just definition wise, that means they're only getting paid if the primary beneficiary is no longer living. Yeah, we see that commonly. So if you wanted to list minor children as a contingent, I don't lose any sleep over that. That's okay. I would still prefer you name an adult, maybe a family member, an aunt, an uncle, a sister, whatever, that's somebody that's going to look out for those kids if something happens. And, God forbid, if the primary wasn't living at the time of the insured's death. But again, it's all things we think about is, being sure we're naming a proper beneficiary. And then the other big thing I learned from this attorney is we want to always be sure our beneficiaries, not only on our life insurance, but our 401ks, our bank accounts, be sure your beneficiaries are up to date. Is this person no longer living, or is this, person been excommunicated from the family, or be sure you're designating the person that you want or needs the proceeds of the policy. And along those lines, be sure the person knows that they're the beneficiary. In today's world, I wanted to comment on this. Usually, even if a beneficiary doesn't know that the insured died, insurance companies subscribe to enough databases and obituary reports that, interestingly, usually they'll find out the person died before, from the insurance company. Oh, sorry for your loss. But with that said, the beneficiary really needs to understand that they're the ones that are supposed to receive the proceeds.
Yeah, there needs to be family communication about family financial planning. And that's a hard conversation to have. And there's
Yeah.
actually specialists, financial advisors, some of them are financial coaches, but there's also um, other forms of financial advisors that focus on family financial planning, who have the skills to teach people how to communicate about money.
Yeah.
I mean, one of the reasons why these conversations don't take place, or people forget, oh, gee, my brother unfortunately died last year, but he was the custodian of the kids. He was the contingent beneficiary. People just don't know, aren't equipped a lot of times to deal with life changes, and to talk about and which can create complications with money and how to address those complications. So people need a heck of a lot of coaching, in order to keep up with the times and communicate things, especially if, their planning, is not agreed to by the kids or other people in the family. The sister might say, why would you make our brother the custodian of the kids? Me, I'm responsible. There's these emotional and family issues that pop up when we do just regular insurance planning, let alone financial planning. And people need to learn how to talk about these
Yeah,
issues.
it's huge.
Maybe we should have a seminar on talking about family, how to talk about money in a family type of thing.
Yeah, definitely.
Maybe do that. Okay, we will wrap it up. I want to thank everybody for coming. Thank you, Darren. Thank you, Charlene. And stay tuned. We have our monthly seminars coming up. They're continuing. The next one's October. Have a great rest of your day, and we'll talk to you soon.